Good afternoon, everyone. Thank you so much for dialing in and logging in for this webinar today with our guest speaker, Dorsie Boddiford Kuni. She's going to join us in just a few minutes, but I'm going to start out with some information on Advanta IRA for those of you who are not familiar. So we are a self-directed IRA administrator. We can hold any type of IRA account, including the solo 401ks, in order for you to make investments outside of the market. If you have not met me before, my name is Larissa Greene. I've been with Advanta IRA for 7 years now. I do education, marketing, and sales here for Advanta. I do a lot of networking at local real estate investment groups, and I also teach a lot of the classes. So you may have heard me on a webinar before or also seen me here in our local Tampa Bay area doing seminars out and about. So that's who I am, and who Advanta is. Basically, self-directed IRA administrator. We've been in business for 16 years now. We only hold qualified funds, so that means we can't help you with any kind of personal cash. We don't make investments for you. What we do instead is hold the account so that you can make investments that you choose. So if you're looking to invest outside of the market, that is what Advanta can help you with. But we don't have any investments to sell you. You have to go out there and find the investments that you want to make, and I'll talk about the investments that we see in just a second. We have 2 offices, but we can help people nationwide and even worldwide. We're here again in the Tampa Bay area of Florida, and we're also in Atlanta, Georgia. We have educational events going on all the time, so if you can't make a webinar or seminar that you see, you can always look at our YouTube channel and find something that is, that you're looking for that maybe you missed, because we do all of the seminars that we do live. We also do them in webinar format, and then we record them all. Like this one will be recorded today, and you'll be able to find it on YouTube so that you can check it out later. We also have classes not only at our offices, but we also do link for those education courses for real estate agents, CPAs, and attorneys. And so there's always something going on at Advanta. And if you're interested, we also do an annual networking event. We do one in Atlanta and one in Tampa, where we invite everybody, all of our contacts, our clients, to network with like-minded individuals so that you can talk about different types of investments that you're making and to see what is going on in your local area. And we should be scheduling those coming up here shortly. I think they're going to be in October, so watch our calendar for that. They'll be up there soon. Advanta IRA does not give any legal, tax, or investment advice. As I mentioned, we do hold the account for you and help you make the investments of your choosing. But if you're going to ask, is this a good investment? Will I get a guaranteed return? We can't answer those questions for you. We do talk a lot about the different types of investments we've seen and even the different types of accounts that you might be eligible for, but ultimately you want to get with a legal, tax, or investment professional that can help you answer those questions. If you're not sure if your question is something I can answer or not, you can always ask it, and if I can't answer it, then what I can do is go ahead and refer you to a tax professional or legal professional that can help you with those questions. So the different types of plans that can be self-directed, I always like to mention them because I think a lot of times people believe for some reason that only a Roth IRA can be self-directed. And so, here they all are up on the screen for you. If it ends in IRA, it can be self-directed, and there are a few other plans in there as well. So a solo 401k, which Dorsie is going to touch on, and also has information on a book she wrote on this type of retirement vehicle, is something that we see a lot of sole proprietors and independent business owners using to make their investments, because there are a lot of advantages to that type of account. I also have up here education savings accounts and health savings accounts, and although those are not retirement plans, the rules for self-directing those plans are exactly the same. So we can hold those accounts for you if you want to open those types of accounts and make those investments. Also not up here that I do like to mention as well is different types of employers plans, as long as they are past employers plans. So if you're not still currently employed with that company and still making active contributions with that plan, it is possible to self-direct those. So 403Bs, 457 plans, pension plans. Again, if you've severed ties with the employer, you can roll those very simply into maybe a traditional IRA or a solo 401k, depending on what you're doing now, and find different types of alternative investments like real estate and mortgages. I would like to kind of give an idea of what we're seeing people invest in, because I think it really gets, your mind going as to where, the different types of investments that you can make. And a lot of times people are like, well, I don't want to invest in real estate, but there are so many other things a self-directed IRA can do. The sky is really the limit. So real estate or real estate-based assets are really the most common investment we see. They make up for about 30% of all of our investments, and that is really the highest number of any asset class that we hold here at Advanta IRA. And we have $1 billion under management at this point, and so you can imagine that's a lot of real estate types of investments. But outside of real estate, there are so many other things. So private stock is another very common one. There are a lot of different businesses that are private stock, and I think sometimes people are surprised, but the certain companies will not hold private stock. They consider it hard to value. They don't want to hold those types of assets, and so we can do that here at Advanta, and it could be anything from like a local bank to some fast food chains, restaurants, and even microbreweries are private stock, and we're seeing clients make those investments. You can also hold tangible assets like gold and silver bars and coins. It does have to be based on what the metal is trading at. It can't be something rare or collectible, but that is an investment that you can make. We see people invest in LLCs, whether it's single member or multi-member, in order to make different investments. We see private equities, commodities, and even farm animals and equipment. So there's a lot of different unique investments that you can make within a self-directed IRA. The paper side of assets, which is really what we're going to talk about today with Dorsie, things like mortgages, something where you really get to determine the rate at which your IRA is going to grow, and I'm going to talk about that in just a second. We also see people investing in things like tax liens, unsecured notes, and I know a lot of times that's very surprising. Clients will say to me, well, who would do an unsecured note? I have to tell you, unsecured notes they outnumber secured notes by far here at Advanta IRA. We do statistics every year for our annual newsletter, and I actually run those numbers, and every year unsecured notes are higher, and I don't know if it's maybe because it's to businesses rather than to individuals, or maybe because they get a better return at times. I'm not sure, but that is the case. We also see people investing in option contracts, assignments, joint venturing, and then what Dorsie's going to talk about, wrap loans. So we see all different types of investments. So the interesting thing about being the bank, as we like to say here at Advanta, is that you get to determine all of those things that the bank would determine if you went and applied for a loan. So how much are you willing to lend? What is the interest rate, the length of term? Is it amortized or interest only? Is there equity participation? When is the payment due, if any? Is this just one single payment at the end of the term, or is this monthly, quarterly? Completely up to you and your borrower. And so you're going to set those terms. And ultimately, it is what you are comfortable with. So when you find a borrower and you guys agree on terms, what is it that you want to do with that borrower? What are you trying to accomplish? And what rate do you want your IRA to grow? And if you think about it, if you have a note in your IRA account, it's almost like having a CD at a bank where you're getting regular payments, you know what to expect, but it has better security at times, if you have it secured by real estate or other types of security, and you're confident in that investment. So we do see a lot of people making those types of investments here at Advanta. So what I want to do real quick before I introduce and bring Dorsie on is give you an example of how this works. And this case study is really just a first mortgage. It's something a little more traditional, just to give you an idea. But basically, in my example, Paul has a former employer plan and is interested in lending that money. He finds the person that he is willing to lend the money to. So remember, we don't put borrowers and lenders together. I think that is a question that I get all the time. But once Paul finds the person that he's willing to lend money to and they agree on terms, he comes to Advanta, lets us know about the investment, and we help him make sure that it's properly titled in the name of the IRA, and then we help him with all of the record keeping that goes along with it. So in my example, the loan amount is $120,000 with an interest rate of 8%, and it's a 5-year balloon with a monthly payment of $800, and Paul is happy with a first mortgage on the property. what you do want to keep in mind as well is that Paul is not only going to bring the investment to us, but he's going to do all of his own due diligence. So it's important that he checks into the borrower, does his due diligence on the property to make sure that if the borrower doesn't pay and he does have to foreclose, that he's going to recoup some of his investment by taking that property back. So the process is very simple. It's opening an account with Advanta. We'll help you move your funds over. And then we don't prepare any legal documents, so he's going to work with his attorney for the note and mortgage. And then once that's done, he'll bring it to us, and his account manager with Advanta will make sure that it's properly titled, showing the IRA itself as the lender rather than Paul personally. And once Paul signs off on all the documents letting us know that he's reviewed them all, we'll go ahead and wire the $120,000 per his agreement with his borrower, and now his IRA holds a note. And those payments will go back to Advanta. We'll deposit them into the account, and Paul will be able to follow along with those deposits from either checking his online statements or receiving emails based on those deposits, whatever he prefers. Once the borrower is ready to pay that back, the money is going to go back to Advanta IRA along with all those interest payments that he's earned all this time, and Paul will be ready for the next investment. So it is really that simple. When you're using an IRA, it is just as you're used to investing. The biggest difference is the funding source and then, of course, where the income goes back to. So, and that kind of gives you an idea of the process. Now I'd like to introduce Dorsie. Dorsie, how are you doing today?
Hi, Larissa. Thanks for having me on.
Absolutely.
Yes, I want to talk about wrap loans and going to talk about like how we can do these deals with our own personal money, but also these deals are great for using our self-directed accounts, like all the accounts Larissa just spoke of. So I want to first start out with just talking about wrap loans, and then we're going to go into using wrap loans with, I'm going to show you some deals that I've done with my solo 401k with wrap loans, and then also with IRAs. So as I go through, I'm going to be showing you a bunch of examples, and in many cases, I'm going to be talking about where I am the wrap lender. But sometimes, you know, it's good to take a step back and think, okay, can I put my accounts in these wrap loan situations, or do I have some financial friends that are, you know, disqualified parties, you know, somebody else that I might be able to help out with their IRA? So just kind of think about it from different perspectives and look at these structures. And let's go in. So first of all, sorry, I'm trying to get this figured out. There we go. Okay, so I want to start out with a deal that I just did. I loaned out $8,000 on the deal on February 8th of this year, and then I received 4 monthly payments of $520. And then on July 10th, that flip investor sold the deal, and he paid me off with $10,515. So my little $8,000 investment, it generated $4,595 profit over just 5 months. And if you were to figure that out, that rate of return was over 122%. So, okay, first of all, how is that return even possible? And secondly, how can I be a lender when I only have $8,000 into a deal? Well, that's where these wrap loans are so great. You can do these deals whether your account has a little bit of money or a lot of money. You can structure these types of deals in a wrap loan, and you're able to get that money working. So when I first started out as an investor, I started self-directing my solo 401k, and I did not have a lot of cash. I didn't. And I wanted to be a lender, but it's kind of hard to be a lender when you only have a little bit of money into an account. So by looking at these wrap loan structures and by structuring this way, I was able to grow my account to now where I can do these types of deals where I can loan the full purchase amount. But I'm going to tell you a little bit later why I don't choose to do the full purchase amount. And I just try to keep doing these wrap structures, and they help out a lot with growing my accounts. So taking a step back, what is a wrap loan? First of all, a wrap loan is a loan and includes an underlying loan. The wrap loan, it profits on the wrap investment terms, but it also profits on the spread on the terms in regards to that underlying loan. And it's different from just having your first and second position mortgage in that in the second position mortgage, the face amount of the wrap loan overstates the actual indebtedness and states a special agreement between the borrower and the wrap lender for payment on the underlying loan. So some of you all might be like, wait a second, I've heard about wrap loans. I know that's where you can buy a house with maybe a mortgage on it. You put another mortgage on it and wrap it and sell it. Well, if that's kind of how you typically think of wrap loans, you can do those types of deals too. But I'm looking at it from more of a private lending perspective. So that's where two loans are being made at once and there's a single borrower. So another way I like to look at it is think about how you have an underlying loan. It has a certain dollar amount, certain face value, and it has certain terms, a certain interest rate. And then behind it, in second position, comes a wrap loan, and there's a little bit of money added onto that usually. And so that face amount is a little bit higher, but it includes the underlying loans amount as well. And then the interest rate on that wrap loan would also be a little bit higher, but again, it includes that interest on the underlying. So that's where the returns skyrocket, is when that interest that the wrap lender receives on the spread in regards to the underlying. So another way to look at it is you've got a single property usually, you've got a single borrower, and there's two loans being made, okay? So that wrap lender is not borrowing the funds and turning around and lending it back out. No, it's two lenders. There's the underlying lender and the wrap lender. They're both lending to a single borrower on typically a single piece of collateral. So how is this different than just your standard first and second position mortgage? Why do I choose to do a wrap loan rather than just come in with a second position mortgage? Maybe I'm bringing the rehab money in. Why would I not just do it straight up first and second? Well, first of all, a lot of times, and in some of these examples I'm going to show you today, many times as the wrap lender, I'm bringing the borrower and the underlying lender together. Usually I'm the one putting together the deal, structuring it, making sure my borrower gets all the money he needs, and usually I'm getting another investor, maybe it's their IRA, maybe it's their personal funds. I'm getting that money working at the rate that they require. So I am usually putting them in touch. However, with the wrap loan, I am wrapping that underlying. So I'm more a principal in that transaction as well. Whereas if I was just coming in second position, I might look like I'm brokering a little bit if I'm just putting them in touch with each other, constantly doing these kind of deals and just coming in second position. Secondly, and I'll talk about this more throughout the presentation, but that wrap lender usually controls the underlying loan. There is usually a relationship between that underlying lender and the wrap lender. So there's some benefits that the wrap lender will bring to the situation. Not only is that wrap lender getting the underlying lender, the deal and getting his money working, but in second position, they don't want to be foreclosed out. So a lot of times there is a relationship there. We'll talk about how payments are being made. A lot of times the wrap lender is kind of babysitting the deal and making sure that the deal is moving along nicely. Whereas if you just had a regular first and second position mortgage, there's not usually that close of a relationship between the underlying lender and the wrap lender. And in many states, it's not even required that the underlying lender notify all the subsequent lenders personally that they're, going to foreclose them out of the deal. So if that borrower stops paying, that underlying lender could foreclose, and everyone else who is in that chain could pretty much just be left high and dry. And then thirdly, and this is the most important about the wrap loans, is that wrap lender, they'll profit on the spread of the terms in regards to the underlying loan. So if it was just like a straight up second position mortgage, they're only going to get the interest and the points and that return that note is giving them. However, if it's a wrap note, not only are they getting the interest and points on their own money that's involved in the deal, but because their loan includes the underlying loan, they're going to get the spread in what that underlying loan gets. So the best way to talk about wrap loans is just to kind of go through some examples, and maybe this will hit home to how maybe you can structure some of your deals so that you can wrap. This was a house a couple of years ago. An investor approached me, and this was someone like I met at seminars, always networking. Whenever I go to real estate events, it's always great to network because you're not only going to find the lenders who are maybe kind of passive and they've got the money. Maybe they used to flip a lot. Maybe they're landlords and they're not as active in the business finding deals as much, but they want to keep their money working. And then I'm also meeting people who are trying to build their rental portfolio. Maybe they're trying to flip, and they don't always have the connections to those lenders. So this was the case. This investor, he was a landlord, and he was going to buy another rental property for his portfolio. He needed $60,000 to purchase the property, and he was going to hold it as a rental. And he was willing to pay 10% and 3 points for a 5-year loan. Well, I had $2,000 that I wanted to get working, and I knew of another lender who would be able to bring in the $58,000. And he was willing to also loan at 5 years, and he wanted 8% and 2 points. So the way this deal was structured, that $58,000 came from the underlying lender. So he loaned it to the landlord investor at 8% and 2 points. I put my $2,000 in for a $60,000 wrap, and I loaned that $60,000 wrap to the borrower at 10% and 3 points. So the lender comes in, again, with majority of the funds. I come in with $2,000. There was a total of $60,000 being given to the investor borrower. And that was broken up with the $58,000 first position loan from the underlying lender at 8% 2 points. And then my wrap loan came in second position, $60,000 at 10% and 3 points. So when the payments are being made, because my wrap loan includes the underlying loan, the borrower is going to make me the payments each month. And out of that payment that the borrower makes me, I'm going to make the payment to the underlying lender. Now, I am not obligated to pay the underlying lender. I have an agreement with the borrower that says, hey, as long as you pay me, I'm obligated to make your underlying payment. But if you don't pay me, I do not need to make any payments on your behalf. So again, and this is a typo here, it wasn't the flip investor again, he's a landlord investor. So he pays on the wrap lender's loan at 10% interest for 60 months, a present value of $61,855. That's because we finance the points into the deal so that our borrowers do not usually have to come to closing with any funds. We'll just go ahead and finance that in. And payments ended up being $600 payments. That was interest, and it amortized the loan a little bit as well. So out of that $600 payments each month, the wrap lender pays the underlying lender's loan 60 months at 8% interest. $59,000 is the value there because his points were also financed in, and he got $450 a month out of that $600 payment. So prices in the neighborhood continue to rise, and after almost 2 years of renting out that property, the landlord investor decided, for whatever reason, he wanted to sell. So then the wrap lender and the underlying lender, we were paid off at the closing. So what kind of profit was this for the wrap lender? Well, I received $600 payments, and out of that I paid the $450, and this loan was out for a total of 51 months. So that was $150 I received each month. That was a total of $3,150 that I kept from those payments collected each month. Then we had the payoff when he went to sell the house. So the wrap lender, I received $60,347 at the payoff, and the underlying lender got his $58,000 at payoff. So $2,092 payoff at closing minus my original $2,000 wrap investment. So that was just a little $92 profit at closing. So total over those 2 years, that was $3,242 total profit. Okay, not big money, but remember, I only put in $2,000. So what kind of return was this? If you figure this out with using a financial calculator, I always like to kind of take a step back at the end of all my deals and see what my actual return was. Because if I can just make sure that I'm hitting good returns on all of my deals, maybe one deal might not be so great. As long as I can average it out, I keep my risk low, I keep my average returns high, and I know that my account is growing. So it was out for 21 months under N. I'm solving for solving for my rate of return. Present value, remember I put in $2,000, so it's a negative $2,000. Each month I received $150 out of those payments. And the future value, my payoff when it sold, was $2,092. So interest, my return was over 91%. So not bad. And you know, like, this is not a lot of money we're talking about, but you can add some zeros on here. I wanted to illustrate this to show you don't really need a lot of money to be a private lender, but you can certainly wrap at any amount of money. I would say there are some investors out there who they might not even put any money into a deal and wrap. They might put just a little bit of money, maybe $100. I would say you want to make sure you put enough money into the deal where it shows that you actually have sufficient skin in the game. So it shows that you're an actual investor in the deal and you are in fact not brokering. So just a little reminder there. Okay, paperwork. Actually, this is not that complicated. It's not that much different than just your regular mortgage, your regular loans that you would make. So here are the documents that are involved in these kind of deals. First of all, you got the first position mortgage, the underlying lender's note. So you got, first of all, you got a note from the borrower to the underlying lender. You've got the face value of that underlying loan, and the terms, again, were 8% and 2 points. Then there's a security instrument that secures that note to the property, and this is what's on record typically, and again, from the borrower to the underlying lender for that note. Then you have the wrap loan that you need the documents for. You're going to have a wrap note, and that's also, again, from the borrower to the wrap lender. And the face amount of the wrap note has the 3 points financed in, and that was at 10%. So that note is going to be very similar to the underlying note. I typically like to take that exact same document and copy it and fill in all the information for the wrap note because I want to make sure that they look alike. I don't want to make there be any confusion as to like if there's any penalties or you know, any other language. I just like to have them mirror each other so that it's very straightforward and there's no confusion for that borrower. Then another one of the differences is that this wrap note is going to have a note rider. And in that note rider, that's where I spell out how the payments are going to be made. So that's where the borrower and the wrap lender, they agree you know, however they're structuring the deal. And typically that's where I say, okay, as a wrap lender, I'm obligated to pay on this underlying note as long as you pay me, but I am not obligated to that note if you do not pay me. And then lastly, you have a security instrument in second position that secures that wrap note to that single property. And that security instrument is going to reference that first position security instrument. It's going to reference that underlying loan. So if you were to look this deal up on courthouse records, you'll see that security instrument for the underlying note, and you see the second position security instrument for the wrap note. And if you read on down in there, you'll see that that second position security is a wrap referencing the underlying loan. So you could, you know, some people say, well, you know, when you look it up like really quick, maybe online, you have the ability to look up what mortgages are on a particular property. Someone looking at this property might say, oh my goodness, you know, this property is way underwater. They have so much leverage on this property. They've got a $59,000 first position mortgage, and then they have a second position mortgage at almost $62,000. But somebody who really is looking at the documents is going to see that it is in fact a wrap note. Okay, so let's jump back. Let's go back to that 122% deal. Now that we've talked about what a wrap loan is, let me explain a little bit about that last deal. So in this case, this was a flip investor. He needed $65,000 to purchase a property. And when he came to me, this was someone I met at a evening RIA meeting, and we discussed, you know, I looked at the deal, I did all my due diligence, made sure it was a deal that I would do myself if I was him, and he agreed to pay 15% and 5 points for the loan. So kind of risky, it needed a lot of work, but he was probably just going to wholesale it off anyways. So I didn't have the full $65,000, but I did have $8,000 that I wanted to invest in this deal. So I knew another lender who had the remaining $57,000, and he was willing to lend at 8% and 2 points again. So I loaned that flip investor $65,000 plus the 5 points, and this included that $57,000 underlying loan, and then I put my $8,000 into that wrap loan of $65,000. So for 4 months, I received monthly payments of $860, and out of that payment, the underlying lender got $340 each month, so that meant I kept $520. So on July 10th, that flip investor, he sold the property at a profit for $150,000, so he was really happy. He was able to do the deal. Everything closed out great. The underlying lender, he was paid off with $58,000, so he was happy, got some interest and points on his money like he wanted. And then I kept the difference in the balance of the two loans, which ended up being the $10,515. So my little $8,000 investment, it generated the $45.95 profit over 5 months, and that's where that rate of return ended up being 122%. So these little deals, it was only out for 4 or 5 months, but if I can do a couple of these deals a year, even just one of these deals a year, that's good. That's a good way to kind of to get that money working and to get it growing. Okay. I also want to now, so those were deals that I've done with personal money. I want to show you another short-term wrap loan example, but this one includes a solo 401k and a Roth IRA. So I like to call this my tax-free wrap loan example. This was an investor borrower who had a flip property deal, and he had purchased this property already, and he was looking for a $45,000 loan. He had to get a lot of permits pulled. He had a lot of work to do on this house. So it was free and clear, but he needed a loan so that he can continue with the deal and flip it. So he purchased it for $17,000. He figured about a $36,000 rehab. Again, he was looking for a $45,000 loan, so he was already putting some of his own money into the deal. And he figured after repair value of about $110,000. So I did all my due diligence, met with him, looked at the property. It looked like it was a deal, that I was willing to be involved in. So this wrap lender had $20,000. I had $20,000 in the solo 401k. So I didn't have the full $45,000 that he needed to get the deal going. But I knew another lender who would be able to help out. So this lender, he had $25,000 in a Roth IRA that he was willing to loan, and he wanted 12% and 2 points for a short-term loan. So I presented the deal to him. He was out of state, and so, I had to really do all my background, all my due diligence, presented pictures to him, and he felt comfortable, and he felt like this was something he wanted his IRA to lend on. So this is the way we structured it. That underlying lender, his Roth IRA, put in $25,000 into the deal. So he got his 12% and 2 points. That's how his note was structured. My solo 401k put in $20,000 on a wrap loan behind him. So the total wrap loan was $45,000 in second position, and that was at 15% and 5 points. And then again, that underlying loan was $25,000 at 12% and 2 points. So here are the documents. First of all, we had a note from the borrower to the underlying lender's Roth IRA. You had the face amount, which included the 2 points financed in. Terms were 12 months, 12% interest. This was a little bit of a longer short-term loan because this investor needed to pull permits. There was a lot more work involved, so we felt comfortable giving a 12-month loan on this one. So payments coming to the Roth IRA were $265 a month. Then there was a security instrument from the borrower to the Roth IRA, securing that note to the flip property. Then there was a note from the borrower to the wrap lender's solo 401k in the amount of $47,000. That's the 5 points financed in, so that's $45,000. Terms were 12 months and 15% interest. Payments ended up being $625 a month. Usually in these kind of cases, we do interest-only payments, but we like to keep nice round numbers, so a lot of times they'll amortize the loan down a little bit, so that's why you see those numbers where they are. And then there's also a security instrument securing that note from the borrower to the wrap lender's solo 401k secures it to that flip property, and it's going to be in second position behind the Roth IRA note. And then there's also an agreement between the borrower and the wrap lender on how payments are going to be made, okay? So the borrower ended up selling the home for $129,900. He did an excellent job with the rehab. It looked great. We were very pleased with how it worked. It all worked out. The underlying lender's Roth IRA, he received the $265 a month in cash flow and $510 in points. So he's happy that he got his Roth IRA working. And my Solar 401k received $360 a month in cash flow and $1,850 on points. So if you were to figure all that out, the wrap lenders, my Solar 401k return, it was 29% return on that deal. And actually probably was even more than that because there were no taxes involved. This I did with my Roth component of my Solar 401k. So the taxes had already been paid, so that growth was tax-free. So that's why I like doing these kind of wrap loans in my Solar 401k and also, with Roth IRA funds as well. I'm going to talk a little bit now about some things you need to remember about when you're doing these wrap loans with your retirement funds, with your self-directed accounts. So I'm going to breeze through this real quick, and then hopefully we'll have some time for some questions when I'm done with this. So if you think of any questions, hold on to them, and I think Larissa's going to give us some time here at the end so we can address some of them. But I want to touch on them. Yeah.
Dorsie, let me just interrupt real quick.
Sure,
I did forget to mention it. We keep the webinar muted, so if you do have questions, just type them into the chat box, and we'll get them answered at the end. But then, Dorsie, you did actually have one question pop up on the $8,000 loan you did, and I thought before we go on, we get it addressed. Okay. With the points payments, did you get $80 on the deal regarding your $8,000 loan?
Okay, so my $8,000 loan, let me see if I can find it. So, yes, so I got the points. There were points involved. There were 5 points. So my $8,000 got 5 points on that, but then I also got 3 points on the $57,000 because there's that spread. The $57,000 underlying, he received 2 points. So total there was 5 points, right? So I got the 3 points on that $57,000. Did that answer? Was that the question? I apologize.
Yeah, I think you answered it. Thank you.
Okay. Yeah, so it's always on the spread. That's the great thing about these wraps is that not only are you getting your own return on your own funds, but you're getting the spread on the underlying. Okay, so one question I get sometimes where people are like, hey, why would I want to do this in my IRA? Won't I trigger unrelated business income tax? I don't have time to go into what all unrelated business income tax is, but if you kind of thought about that and that was a question you had, you don't have to worry because there is a IRS private letter ruling. It said wrap loans do not constitute UBIT because they are not considered acquisition indebtedness and because, first of all, if you're wrapping the loan, you're not liable to the first mortgagee for the missed payments from the borrower. Remember how I said that there's like an agreement usually between the wrap lender and the borrower for how they're going to make payments on the underlying? Well, you're not liable to them for missed payments because you're not actually borrowing the money yourself either. And then number 2, you do not have use of the property or the income it generates. Here, you're strictly a lender. You just have a note on the property. You do not have use of the property. And again, when you're doing these kind of deals in your self-directed accounts, you do need to remember the prohibited transaction rules. You need to be careful about who disqualified parties are. I'm sure Advanta has some great education on that if you need to come up to speed with what all that means. But you do need to kind of keep all that in mind when you're structuring these types of deals. Also, you have to be careful that you don't do too much yourself in these kind of deals because you can also get in trouble for providing a service, providing too much to your IRA or your Solar 401k. So one of these things is like servicing the loan. So if you're outside of your IRA, if you're just using your own personal money and you're wrapping deals, typically the way I structure it is that the wrap lender will accept payments from the borrower and then the wrap lender will pay the underlying. So just straightforward, money comes in at the month, it's deposited into the account, I cut the check, and I pay the underlying. Well, if I'm using my IRA to fund these deals, and I'm using my IRA to wrap, I've got it structured a little bit differently. So in those kind of deals, I could have the borrower cut the check to my custodian, and then I could direct Advanta to make the payment out of that payment for my IRA to pay the underlying loan. And that might take a little time. There might be some fees involved there. I might not even realize that the borrower hasn't paid on time. It's just a lot more difficult. It gets a lot more confusing. So in those kind of situations, I like to inform the borrower that they're going to make 2 payments. So 2 payments are going to be made each month, and those checks are going to be sent to me, to the wrap lender. So 1 envelope, 2 checks. First check is going to be payment to the underlying lender. So borrower is going to be cutting that check to the underlying lender, and then borrower is going to be cutting a second check to the custodian, to that wrapping lender, to the IRA, okay? So, and that's going to have the difference. So instead of paying 1 payment, he's going to be paying that 1 payment cut up into 2 checks. I usually have them go ahead and send it to me, just so I can open up the envelope, see that there are 2 checks there to know that the deal is still going strong. I've got my thumb on the pulse. I know everything is moving along. Then I take those 2 checks. I send the 1 check to the underlying lender for the payment, and I send the other check to Advanta so they can deposit it into my IRA. Okay? Now, the last deal I just showed you, my solo 401k was wrapping. So in that case, I go back to this type of structure because my solo 401k, I have a lot more freedom with that. I have full checkbook control because I've set it up to where I am my own trustee and I'm also my own plan administrator. So I literally have a checkbook for my solo 401k right here at my desk. And when a deal comes along that I want my solo 401k involved in, I can just pull out my checkbook and I can sign it as trustee and I can fund the deal with my solo 401k. So when I get the payments coming in off that deal, I have the full control to cut the check to the underlying lender. Okay, so let's take a step back. So what if that borrower defaults? What if he decides he isn't into this deal, he wants to go off to Mexico, whatever? What if he stops paying? Well, if the borrower defaults, the wrap lender could continue to pay the underlying lender and inform the underlying lender that the borrower is in default. So I would do this because I want to make sure that my wrap loan doesn't get foreclosed out just because that borrower has stopped paying. So if the borrower stops paying me and I'm supposed to be paying the underlying lender, well, I no longer have to pay him if I'm not getting paid. But I probably more than likely will pay on the underlying loan because then I can accept either the late fees or I can start the collection actions. And I could foreclose on the deal and I could step in and complete the deal myself and make the profit, and my underlying lender is still happy because he's getting the return that he first anticipated. But I have to be careful because what if I'm doing this in an IRA? I can't just step in and take over if it's my IRA involved, right? Like there's rules against that. So what if the borrower defaults and I've wrapped with my IRA funds? Well, there's a couple of different things I could do. My IRA could sell that non-performing wrap note to an unrelated third party. I could sell it, just be done with it, nice and clean, walk away, take my losses, whatever. My IRA could foreclose on the property, but then I'd make arrangements to maybe finance the property to another buyer. So I kind of keep that same structure, but just put another buyer, another investor in place to where they can fix up the deal and sell it and make a profit. And then third, my IRA could foreclose and then maybe just pay a general contractor who's doing all the work, making all the decisions, and have him finish up the rehab and sell the property. And all the while, my underlying lender is getting paid through all of this. So there's some things you need to think of if it's in your IRA or even a solo 401k. I want to be careful with how much I'm actually doing with the property. So we talked about if the borrower defaulted, well, what if I stop paying? What if the wrap lender stops paying on the underlying loan? What if I'm just collecting the payments from the borrower and I just don't even go ahead and I told that borrower I would pay my underlying lender, but what if I'm not? Well, that underlying lender, remember, is in first position. So he has the strongest collateral. He's got the most security in the deal. So he could, go behind me, contact the borrower and say, hey, I'm not getting paid. You need to send me the payments directly to me. Okay, and then that underlying lender could foreclose me out of the deal. Also, if it's a significant amount of money that rep lender is collected from the borrower and not paid the underlying, that borrower could potentially sue the rep lender if those payments were, in fact, having been made. So point is everyone is secured in this deal. Everyone, has some security. There is communication going on. Everyone realizes that this deal, they know when things start going bad. The biggest thing is that underlying lender, that the underlying lender knows that the borrower isn't paying. So like if the borrower has stopped paying, the biggest thing is that the rep lender needs to be in communication with the underlying, say, hey, I'm going to continue making the payments, or vice versa. Okay, so last thing I want to touch on is, what are the benefits of investing your self-directed funds in wrap loan deals? Why are these wrap loans, why are they so great to be thinking about with your retirement funds? Well, first of all, like my first couple of deals that I showed, you don't need a large amount of funds to be able to do these wrap deals. There are so many different ways you can structure it. Even if you put up, and I didn't have time to show an example today, but I've wrapped where I've had the majority of the funds in the deal and the underlying lender has just put in a little bit and they still get in first position. You can still do that. I mean, you're still going to up your returns as long as there is some type of wrap structure there. You might not get as high of a return, but you're still going to get higher than your straightforward terms. So first of all, you don't need a large amount of funds. There's no UBIT on these deals if you do them correctly, just as we discussed. I like to think of it as like hands-off investing for easier arm's-length transactions. So I'm like very careful that I'm doing these types of deals with unrelated third parties, with people who are not disqualified. And so I think that lending and using this wrap loan structure is a little bit easier for me to make sure I know who all's involved and that everything is remaining straightforward and I'm playing by the rules. I also like that I'm working with other capable investors. I mean, these are usually my retirement funds. I really, take care of these funds. I mean, this is what I'm going to have to live off of later on. So I want to make sure that I'm investing in good deals with other people who are knowledgeable and who are going to take good care of my money as well. Also, lower risk. I like investing in notes and mortgages rather than having real estate in my retirement accounts. There's a lot less liability in paper than if you have a tenant involved with some of your IRA funds. I also like to optimize my returns with the wrap loan structure, like I showed, how you can get over 100% returns on these types of deals. But also you can optimize the returns by doing multiple loans simultaneously. So even though in some of these deals, I might be able to loan them the full amount for their flip project or their rental property, but I choose not to because I would rather spread out the funds. I would rather, not put all my eggs in one basket, keep everything lower risk that way, and optimize my returns that way. So that's why I like using wrap loans in my solo 401k and my IRA. And I want to just point out real quick, if you're interested in learning more about wrap loans, I have a home study course called Wrapping for Profits. It's got some audio discs and a full manual, and you can find this at website assets101.com. Also, here's my email address. If you have any questions, I'd be happy to email back and forth with you, dorsieb@gmail.com. And we also, my father and I wrote a little book called The Solo 401k, The Entrepreneur's Guide to a Powerful Pension Plan, talking about all the great benefits of the 401k and how you can use your 401k as an entrepreneur and a small business owner. And again, I really like to self-direct my solo 401k. That's what I focus on mainly. For many other benefits that I don't have time to talk about today, but I hope you learned some good stuff on the wrap loans, and maybe you've got some good ideas about how you can do your next deal. And Larissa, do we have time to answer a few questions?
Yeah, we do have time, and we have quite a few questions, and I just want to remind everybody, quickly get your questions typed into that chat box so we can get them answered. And before we start with the first question, I do want to mention with Advanta IRA, you do have both options for the solo 401k. You are able to have us be your administrator, or you can do, as Dorsie mentioned, be your own administrator and just lease our plan documents. So the IRS does require you to have approved plan documents. We do lease those for you to you for a low annual fee where you can then have your 401k at any bank account that you choose and then have checkbook control. So you do have both options with Advanta. And then also, if you do a wrap loan and you have an IRA and we're your administrator here at Advanta, we will treat that underlying loan as an expense. We do turn checks around very quickly. However, the biggest time that you're going to run into is we do hold checks for 10 days. So just to give you a little bit of information about how we can help you with those things, we are familiar with wrap loans. We can help you with them. We will treat it as an expense. We can set it up as a reoccurring payment so that once the payments come in, we just turn that check around to the underlying lender, but we're going to hold any check we receive for 10 days. So that's going to be the biggest stretch of time that you're going to be waiting on. Once those funds are ready, though, we'll send that check out the same day. So we're pretty quick about that. Our staff here is very quick about handling those types of things. So with that, Dorsie, our first question, do you find it common that the lender adds points to the note at payoff?
Do I find it common that the lender adds points to note at payoff? I mean, that's what I typically do. When you're thinking about wrap loans, like just think about your hard money lending rules and like what you would do as just a regular lender. And I kind of stick by my same policies, whether it's a wrap loan or just a straightforward loan. I like to, I only lend up to 60 to 65% loan to value. So in many cases, my borrowers don't even have to bring any money to the closing. In many cases, they're finding deals where they have lots of equity in the deals, and that's perfectly fine with me. You know, if I've done my due diligence and I feel comfortable in the deal that I'm under 65% loan to value, then that's fine, and I'm willing to finance those points in. Also, like I'm a borrower myself. I flip. I have rental property as well, and so when I ask a lender for, you know, a certain dollar amount, that's what I need to do the deal with. You know, I would like to see that money, you know, if the lender approves me. So I kind of want to do the same for my borrowers. You know, if they ask for $65,000, that they get the $65,000, and they don't have to worry about the rest until payoff.
We also have a question up here. Does the first position lender necessarily have to know about the wrap?
Good question. Does the first position lender have to know about the wrap? Well, yes. Typically, yes, because you're going to be on record as a wrap lender. And another question I get is, does the borrower have to know what the terms of the underlying lender's loan are? Like, you know, if that underlying lender is only charging 8% and 2 points, you know, why doesn't that borrower just go straight to that underlying lender and not come to me next time? Well, the wrap lender provides some benefits here for the underlying lender and for the investor borrower. First of all, I've got that money together so that that investor can do the deal. I've been able to put that underlying lender in touch with him, and vice versa. I've been able to get that underlying lender's money working. And that's going to be a relationship that, like, there's going to be many other deals being made after that. Also, you know, the borrower at closing is going to have to sign both of those notes, right? I mean, he's giving a note to the underlying lender and a note to the wrap lender, so he's going to see everything there. So before closing, you know, first of all, I always want to make sure I'm closing with a closing attorney or a title company that understands wraps. Because at closing, I want everything to go smoothly. If there's any questions, if the borrower has any hesitations, you know, those can all be addressed at closing and everything can go smooth. But as a wrap lender, I want to reach out to that borrower, and typically what I do is I do all my due diligence on the deal. I talk with the borrower. We negotiate the terms. You know, we agree on what his payments are going to be, what his interest rate is going to be, all of that. And then when I realize I'm going to be doing a wrap structure, I then call up the borrower and I say, hey, you know, this was the deal we agreed on. I'm going to be funding you this amount. These are the terms you agreed to pay me. I want to let you know that the funds for this deal are going to come from a couple of sources, but I want you to know that at closing, you know, the only thing you're going to be needing to pay is that 15% and 5 points, or the 10 and 3 points that we agreed on first off. So you'll see that there might be another lender involved. That's just because we're working together on this deal. And if you have any questions, please ask the closing attorney. They'll be able to help you through. And, I've never had anyone push back on that, Larissa. Like, I've always, as long as you're being straightforward with everyone from the get-go, and being honest and upfront, then everything's going to be just fine. Also, if that investor borrower on the next deal just goes straight to that underlying lender, that I might be losing out on the deal, but do you think, I think that my underlying lenders, we have a relationship to where they'll be loyal to me, but also the borrowers will as well, because I'm able to get that money when other lenders aren't able to perform, and also I'm able to get the money working for those lenders who otherwise would not have the deals that they have. So everyone's providing a benefit.
Yeah, so they basically appreciate full transparency.
Yeah. Right, right.
That makes a lot of sense. Last question here. If the underlying investor is a bank, can this still be done as a version of a subject to?
Can this be done as a version of subject to if they're a bank? Yes, you could. I don't really touch on that, though, because, quite frankly, I do not use institutional money. I'm usually working with investors, and there is so much more resources for me as far as working with other private lenders than working with banks. It would be a little tougher with an institution. I don't have time to walk through all of that right now today. But again, what I was talking about today was making two loans at once. You have to be careful if you're buying a house subject to a bank mortgage and maybe you're fixing it up and you're putting your own mortgage on top of that. You're wrapping that bank mortgage and selling the house with owner financing. That's kind of one of the structures that a lot of investors have thought about traditionally, and that works, but you have to be careful for a number of different things. Due on sale clauses, there's a lot of things you need to be aware of, but also it could be seen as usurious if there is already an existing loan. So I'm always careful to make sure that my borrower sees that his payments are what we agreed on, rather than there already being some interest and points and terms and payments already in place, and then I'm stepping in and wrapping it. Well, that might not look so clean as if we were to do the deals together. So I'd be very careful about doing those kind of deals, but it's not impossible either.
Okay. And we have time for one more question here. What is the typical cost involved in, this loan, to you from start to finish, including the paperwork, any attorney that you might use? Is there kind of a standard that this is what it's going to cost every time you go into this deal?
Okay, so like cost from the wrap lender's perspective? Is that what you mean, just as a lender?
Yeah, wrap lender, okay. So what your documents cost, do you involve an attorney? What does that be? Do you kind of have like an estimated percentage that it's going to cost you, or what does that look like?
So it's going to depend. It's going to depend on like who. Like, a lot of the times, like for closing for every individual loan, just as any type of private loan, you're going to need to kind of spell out and talk with the borrower about what their costs are going to cover and what your costs are going to be. So usually I don't charge any like administrative costs to the borrower. My costs are pretty low as a lender. For me, I use pretty much the same documents over and over and over again. So the cost to the attorney to consult with me on setting up these documents, I had a local attorney who knew my state's laws, who was an investor himself. So that's going to really just depend on who you have working with you to create those documents. That's going to kind of vary depending on your area and who you're working with. But once you've got those documents, you can just use the same thing over and over again. And also, a lot of times I tell investors, when they don't even know where to start, I say, go to your deeds room or go look online, look at a security deed or a security instrument that is recorded, and just kind of go from there. Look at all the different ones that are on record. And I'm not providing any legal advice here, no tax advice or anything, but I'm just saying from investor to investor, that's one way where you can just kind of do your own research, maybe ask around to other investors what attorneys they recommend, And then once you've got your documents, that's something that you should be able to take those documents and for each deal, alter them based on the deal and use the same documents over and over again. Some lenders like to use servicing companies to collect payments and all, so that's going to, if that's something you're interested in, you're going to need to figure that price in. Otherwise, it's very minimal as far as doing these deals. It's a whole lot cheaper than if you were to actually be buying the property yourself or buying it in your IRA. Okay? Larissa, are you there?
Yes, sorry about that.
Okay, no worries.
Yep, can you hear me okay? Yeah, sorry about that. Thanks, Dorsie, so much for coming on with us today. We really appreciate it. Maybe we can get you on in a couple of months again. We can go into some other things that we didn't have time to do today, but thank you so much.
Yeah, thank you, Larissa. And if anyone had any questions that weren't answered today, again, feel free to email me. I'd be happy to answer you. And I know we breezed through everything really quick, but I hope everyone learned something good. And thanks again, Larissa. I appreciate it.
Absolutely. Take care.